A random walk down Wall Street. The time-tested strategy for successful investing. Burton G. Malkie, W. W. Norton and Company. Independent publishers since 1923. New York, London. Part 1. Stocks and their value. 1. Firm foundations and castles in the air. What is a random walk? Investing is a way of life today. Investing in theory. The firm foundation theory. The castle in the air theory. How the random walk is to be conducted. 2. The madness of crowds. The Tulip-Bulb Craze. The South Sea Bubble. Wall Street lays an egg. And Afterword. 3. Speculative bubbles from the 60s into the 90s. The Sanity of Institutions. The Soaring Sixties. The New Era. The Growth Stock. New Issue Craze. Synergy generates energy. The Conglomerate boom. Performance comes to the market. The bubble in concept. Stocks. The Nifty 50. The Roaring Eighties. The return of new issues. ZZZZ. Best bubble of all. What does it all mean? The Japanese yen for land and stocks. 4. The explosive bubbles of the early 2000s. The Internet bubble. A broad-scale high-tech bubble. Yet another new issue craze. The Globe.com security analysts dollar peak up new valuation metrics. The rights of the media fraud slithers in and strangles the market. Should we have known the dangers? The U.S. housing bubble and crash of the early 2000s. The new system of banking. Looser lending standards. The housing bubble. Bubbles and economic activity. Does this mean that markets are inefficient? The bubble in cryptocurrencies. Bitcoin and blockchain. Is Bitcoin real money? Should the Bitcoin phenomenon be called a bubble? What can make the Bitcoin bubble deflate? Part 2. How the pros play the biggest game in town. 5. Technical and fundamental analysis. Technical versus fundamental analysis. What can charts tell you? The rationale for the charting method. Why might charting fail to work? From chartist to technician. The technique of fundamental analysis. 3 important caveats. Why might fundamental analysis fail to work? Using fundamental and technical analysis together. 6. Technical analysis and the random walk theory. Holes in their shoes and ambiguity in their forecasts. Is there momentum in the stock market? Just what exactly is a random walk? Some more elaborate technical systems. The filter system. The Dow theory. The relative strength system. Price-volume systems. Reading chart patterns. Randomness is hard to accept. A gaggle of other technical theories to help you lose money. The hemline indicator. The Super Bowl indicator. The odd lot theory. Dogs of the Dow. January effect. A few more systems. Technical market gurus appraising the counterattack. Implications for investors. 7. How good is fundamental analysis? The efficient market. Hypothesis. The views from Wall Street and academia. Are security analysts fundamentally clairvoyant? Why the crystal ball is clouded. 1. The influence of random events. 2. The production of dubious reported earnings through creative accounting procedures. 3. Errors made by the analysts themselves. 4. The loss of the best analysts to the sales desk, to portfolio management, or to hedge funds. 5. The conflicts of interest between research and investment banking departments. Do security analysts pick winners? The performance of the mutual funds. The semi-strong and strong forms of the efficient market. Hypothesis. EMH. Part 3. The new investment technology. 8. A new walking shoe. Modern portfolio theory. The role of risk. Defining risk. The dispersion of returns. Illustration. Expected return and variance measures of reward. And risk. Documenting risk. A long-run study reducing risk. Modern portfolio theory. MPT. Diversification in practice. 9. Reaping reward by increasing risk. Beta and systematic risk. The capital asset pricing model. CAPM. Let's look at the record and appraisal of the evidence. The quant quest for better measures of risk. Arbitrage pricing. Theory. The FAMA French 3-factor model. A summing up. 10. Behavioral finance, the irrational behavior of individual investors. Overconfidence, biased judgments, hurting loss aversion. Pride and regret, behavioral finance and savings, the limits to arbitrage. What are the lessons for investors from behavioral finance? 1. Avoid herd behavior. 2. Avoid overtrading. 3. If you do trade, sell losers, not winners. 4. Other stupid investor tricks. Does behavioral finance teach ways to beat the market? 11. New methods of portfolio construction. Smart beta and risk. Parity. What is smart beta? 4 tasty flavors, their pros and cons. 1. Value wins. 2. Smaller is better. 3. There is some momentum in the stock market. 4. Low beta stocks return as much as high beta stocks. What could go wrong? Blended factor strategies, blended funds in practice. Dimensional Fund Advisors, DFA, Research Affiliates, Fundamental Indextum, RAFI. Goldman Sachs Active Beta ETF, equally weighted portfolios. Implications for investors. Risk parity, the risk parity technique. Safe bonds may also provide opportunities to employ risk parity techniques. Risk parity versus the traditional 60/40ths portfolio. Dalio's all-weather fund. What could go wrong? Concluding comments. Part 4, a practical guide for random walkers and other investors. 12. A fitness manual for random walkers and other investors. Exercise 1. Gather the necessary supplies. Exercise 2. Don't be caught empty-handed. Cover yourself with cash reserves and insurance. Cash reserves, insurance. Deferred variable annuities. Exercise 3. Be competitive, let the yield on your cash reserve keep pace with inflation. Money market mutual funds, money funds. Bank certificates of deposit, CDs, internet banks. Treasury bills. Tax-exempt money market funds. Exercise 4. Learn how to dodge the tax collector. Individual retirement accounts, Roth IRAs, pension plans. Saving for college. As easy as 529. Exercise 5. Make sure the shoe fits. Understand your investment objectives. Exercise 6. Begin your walk at your own home. Renting leads to flabby investment muscles. Exercise 7. How to investigate a promenade through bond country. Zero coupon bonds can be useful to fund future liabilities. No-load bond funds can be appropriate vehicles for individual investors. Tax-exempt bonds are useful for high-bracket investors. Hot tips. Inflation-protected bonds. Should you be a bond market junkie? Foreign bonds. Exercise 7A. Use bond substitutes for part of the aggregate bond portfolio during eras of financial repression. Exercise 8. Tiptoe through the fields of gold, collectibles, and other investments. Exercise 9. Remember that investment costs are not random, some are lower than others. Exercise 10. Avoid sinkholes and stumbling blocks. Diversify your investment steps. A final checkup. 13. Handicapping the financial race. A primer in understanding and projecting returns from stocks and bonds. What determines the returns from stocks and bonds? 4 historical eras of financial market returns. Era I. The age of comfort. Era 2. The age of angst. Era 3. The age of exuberance. Era IV. The age of disenchantment. The markets from 2009 to 2018. Handicapping future returns. 14. A life cycle guide to investing. 5 asset allocation principles. 1. Risk and reward are related. 2. Your actual risk in stock and bond investing depends on the length of time you hold your investment. 3. Dollar cost averaging can reduce the risks of investing in stocks and bonds. 4. Rebalancing can reduce investment risk and possibly increase returns. 5. Distinguishing between your attitude toward and your capacity for risk. 3 guidelines to tailoring a life cycle investment plan. 1. Specific needs require dedicated specific assets. 2. Recognize your tolerance for risk. 3. Persistent saving in regular amounts, no matter how small. Pays off. The Life Cycle Investment Guide. Life Cycle Funds. Investment management once you have retired. Inadequate preparation for retirement. Investing a retirement nest egg. Annuities. The do-it-yourself method. 15. 3 giant steps down Wall Street. The no-brainer step. Investing in index funds. The index fund solution. A summary. A broader definition of indexing. A specific index fund portfolio. ETFs and taxes. The do-it-yourself step. Potentially useful stock picking rules. Rule 1. Confine stock purchases to companies that appear able to sustain above average earnings growth for at least 5 years. Rule 2. Never pay more for a stock than can reasonably be justified by a firm foundation of value. Rule 3. It helps to buy stocks with the kinds of stories of anticipated growth on which investors can build castles in the air. Rule 4. Trade as little as possible. The substitute player step. Hiring a professional Wall Street walker. Investment advisors, standard and automated. Some last reflections on our walk. A final example. Epilogue. A random walker's address book and reference guide to mutual funds and ETFs. Index. Part 1. Stocks and their value. 1. Firm foundations and castles in the air. What is a cynic? A man who knows the price of everything, and the value of nothing. Oscar Wilde, Lady Windermere's fan. In this book I will take you on a random walk down Wall Street, providing a guided tour of the complex world of finance and practical advice on investment opportunities and strategies. Many people say that the individual investor has scarcely a chance today against Wall Street's professionals. They point to professional investment strategies using complex derivative instruments and high-frequency trading. They read news reports of accounting fraud, mammoth takeovers, and the activities of well-financed hedge funds. This complexity suggests that there is no longer any room for the individual investor in today's markets. Nothing could be further from the truth. You can do as well as the experts, perhaps even better. It was the steady investors who kept their heads when the stock market tanked in March 2009, and then saw the value of their holdings eventually recover and continue to produce attractive returns. And many of the pros lost their shirts in 2008 buying derivative securities they failed to understand, as well as during the early 2000s when they overloaded their portfolios with overpriced tech stocks. This book is a succinct guide for the individual investor. It covers everything from insurance to income taxes. It tells you how to buy life insurance and how to avoid getting ripped off by banks and brokers. It will even tell you what to do about gold and diamonds. But primarily it is a book about common stocks, an investment medium that not only provided generous long-run returns in the past but also appears to represent good possibilities for the years ahead. The Life Cycle Investment Guide described in Part 4 gives individuals of all age groups specific portfolio recommendations for meeting their financial goals, including advice on how to invest in retirement. What is a random walk? A random walk is one in which future steps or directions cannot be predicted on the basis of past history. When the term is applied to the stock market, it means that short-run changes in stock prices are unpredictable. Investment advisory services, earnings forecasts, and chart patterns are useless. On Wall Street, the term random walk is an obscenity. It is an epithet coined by the academic world and hurled insultingly at the professional soothsayers. Taken to its logical extreme, it means that a blindfolded monkey throwing darts at the stock listings could select a portfolio that would do as well as one selected by the experts. Now, financial analysts in pinstriped suits do not like being compared to bare-assed apes. They retort that academics are so immersed in equations and Greek symbols, to say nothing of stuffy prose, that they couldn't tell a bull from a bear, even in a china shop. Market professionals arm themselves against the academic onslaught with one of two techniques, called fundamental analysis and technical analysis, which we will examine in part 2. Academics parry these tactics by obfuscating the random walk theory with three versions: the weak, the semi-strong, and the strong, and by creating their own theory, called the new investment technology. This last includes a concept called beta, including smart beta, and I intend to trample on that a bit. By the early 2000s, even some academics had joined the professionals in arguing that the stock market was at least somewhat predictable after all. Still, as you can see, a tremendous battle is going on. And it's fought with deadly intent because the stakes are tenure for the academics and bonuses for the professionals. That's why I think you'll enjoy this random walk down Wall Street. It has all the ingredients of high drama, including fortunes made and lost and classic arguments about their cause. But before we begin, perhaps I should introduce myself and state my qualifications as guide. I have drawn on three aspects of my background in writing this book. Each provides a different perspective on the stock market. First is my professional experience in the fields of investment analysis and portfolio management. I started my career as a market professional with one of Wall Street's leading investment firms. Later, I chaired the investment committee of a multinational insurance company and for many years served as a director of one of the world's largest investment companies. These perspectives have been indispensable to me. Some things in life can never fully be appreciated or understood by a virgin. The same might be said of the stock market. Second are my current positions as an economist and chair of several investment committees, specializing in securities markets and investment behavior. I have acquired detailed knowledge of academic research and new findings on investment opportunities. Last, and certainly not least, I have been a lifelong investor and successful participant in the market. How successful I will not say, for it is a peculiarity of the academic world that a professor is not supposed to make money. A professor may inherit lots of money, marry lots of money, and spend lots of money, but he or she is never supposed to earn lots of money. It's unacademic. Anyway, teachers are supposed to be dedicated. Or so politicians and administrators often say, especially when trying to justify the low academic pay scales. Academics are supposed to be seekers of knowledge, not of financial reward. It is in the former sense, therefore, that I shall tell you of my victories on Wall Street. This book has a lot of facts and figures. Don't let that worry you. It is specifically intended for the financial layperson and offers practical, tested investment advice. You need no prior knowledge to follow it. All you need is the interest and the desire to have your investments work for you. Investing is a way of life today. At this point, it's probably a good idea to explain what I mean by investing, and how I distinguish this activity from speculating. I view investing as a method of purchasing assets to gain profit in the form of reasonably predictable income, dividends, interest, or rentals, and/or appreciation over the long term. It is the definition of the time period for the investment return and the predictability of the returns that often distinguish an investment from a speculation. A speculator buys stocks hoping for a short-term gain over the next days or weeks. An investor buys stocks likely to produce a dependable future stream of cash returns and capital gains. when measured over years or decades. Let me make it quite clear that this is not a book for speculators. I won't promise you overnight riches or stock market miracles. Indeed, a subtitle for this book might well have been the Get Rich Slowly But Surely book. Remember, just to stay even, your investments have to produce a rate of return equal to inflation. Inflation in the United States and throughout most of the developed world fell to 2% or below in the early 2000s, and some analysts believe that relative price stability will continue indefinitely. They suggest that inflation is the exception rather than the rule, and that historical periods of rapid technological progress and peacetime economies were periods of stable or even falling prices. It may well be that little or no inflation will occur during the decades ahead, but I believe investors should not dismiss the possibility that inflation will accelerate again at some time in the future. Although productivity growth accelerated in the 1990s and early 2000s, it has recently slowed, and history tells us that the pace of improvement has always been uneven. Moreover, productivity improvements are harder to come by in some service-oriented activities. It still will take 4 musicians to play a string quartet and 1 surgeon to perform an appendectomy throughout the 21st century, and if musicians and surgeons' salaries rise over time, so will the cost of concert tickets and appendectomies. Thus, upward pressure on prices cannot be dismissed. If inflation were to proceed at a 2 to 3% rate, a rate much lower than we had in the 1970s and early 1980s, the effect on our purchasing power would still be devastating. The table on the following page shows what an average inflation rate of close to 4% has done over the 1962-2018 period. My morning newspaper has risen 5,900%. My afternoon Hershey bar is over 30 times more expensive, and it's actually smaller than it was in 1962, when I was in graduate school. If inflation continued at the same rate, today's morning paper would cost more than $5 by the year 2025. It is clear that if we are to cope with even a mild inflation, we must undertake investment strategies that maintain our real purchasing power. Otherwise, we are doomed to an ever-decreasing standard of living. Investing requires work, make no mistake about it. Romantic novels are replete with tales of great family fortunes lost through neglect or lack of knowledge on how to care for money. Who can forget the sounds of the cherry orchard being cut down in Chekhov's great play? Free enterprise, not the Marxist system, caused the downfall of the Renevsky family. They had not worked to keep their money. Even if you trust all your funds to an investment advisor or to a mutual fund, you still have to know which advisor or which fund is most suitable to handle your money. Armed with the information contained in this book, you should find it a bit easier to make your investment decisions. The bite of inflation. Average 1962, average 2018 percentage increase. Compound annual rate of inflation, consumer price index 30.22517, 31.13.9%, Hershey bar 5 cents, $1.59, 3080.06.4%. New York Times 0.053.005, 5900.07.6%, first class postage 0.040.50, 1150.04.6%, gasoline gallon 0.312.908, 35.54.1%. Average 1962, average 2018 percentage increase. Compound annual rate of inflation, hamburger, McDonald's Double 28 asterisk 4.79 16 10.75.2% Chevrolet 2529.00 26,000.00 928.14.2%. Refrigerator freezer 470.00 1397.00 197.22.0%. 1963 data. Source. For 1962 prices, Forbes, November 1, 1977, and various government and private sources for 2018 prices. Most important of all, however, is the fact that investing is fun. It's fun to pit your intellect against that of the vast investment community and to find yourself rewarded with an increase in assets. It's exciting to review your investment returns and to see how they are accumulating at a faster rate than your salary. And it's also stimulating to learn about new ideas for products and services, and innovations in the forms of financial investments. A successful investor is generally a well-rounded individual who puts a natural curiosity and an intellectual interest to work. Investing in theory, all investment returns, whether from common stocks or exceptional diamonds, are dependent, to varying degrees, on future events. That's what makes the fascination of investing. It's a gamble whose success depends on an ability to predict the future. Traditionally, the pros in the investment community have used one of two approaches to asset valuation: the firm foundation theory or the castle in the air theory. Millions of dollars have been gained and lost on these theories. To add to the drama, they appear to be mutually exclusive. An understanding of these two approaches is essential if you are to make sensible investment decisions. It is also a prerequisite for keeping you safe from serious blunders. Toward the end of the 20th century, a third theory, born in academia and named the new investment technology, became popular on the street. Later in the book, I will describe that theory and its application to investment analysis. The firm foundation theory. The firm foundation theory argues that each investment instrument, be it a common stock or a piece of real estate, has a firm anchor of something called intrinsic value, which can be determined by careful analysis of present conditions and future prospects. When market prices fall below, rise above this firm foundation of intrinsic value, a buying-selling opportunity arises, because this fluctuation will eventually be corrected, or so the theory goes. Investing then becomes a dull but straightforward matter of comparing something's actual price with its firm foundation of value. In the theory of investment value, Williams presented a formula for determining the intrinsic value of stock. Williams based his approach on dividend income. In a fiendishly clever attempt to keep things from being simple, he introduced the concept of discounting. Discounting basically involves looking at income backwards. Rather than seeing how much money you will have next year, say $1.05 if you put $1 in a savings certificate at 5% interest, you look at money expected in the future and see how much less it is worth currently. Thus, next year's $1 is worth today only about 95 cents, which could be invested at 5% to produce approximately $1 at that time. Williams actually was serious about this. He went on to argue that the intrinsic value of a stock was equal to the present, or discounted, value of all its future dividends. Investors were advised to discount the value of monies received later. Because so few people understood it, the term caught on, and discounting now enjoys popular usage among investment people. It received a further boost under the aegis of Professor Irving Fisher. of Yale, a distinguished economist and investor. The logic of the firm foundation theory is quite respectable and can be illustrated with common stocks. The theory stresses that a stock's value ought to be based on the stream of earnings a firm will be able to distribute in the future in the form of dividends or stock buybacks. It stands to reason that the greater the present dividends and their rate of increase, the greater the value of the stock. Thus, differences in growth rates are a major factor in stock valuation. Now the slippery little factor of future expectations sneaks in. Security analysts must estimate not only long-term growth rates but also how long they can be maintained. When the market gets overly enthusiastic about how far into the future growth can continue, it is popularly held on Wall Street that stocks are discounting not only the future but perhaps even the hereafter. The point is that the firm foundation theory relies on some tricky forecasts of the extent and duration of future growth. The foundation of intrinsic value may thus be less dependable than is claimed. The firm foundation theory is not confined to economists alone. Thanks to a very influential book, Benjamin Graham and David Dodd's Security Analysis, a whole generation of Wall Street security analysts was converted to the fold. Sound investment management, the practicing analysts learned, simply consisted of buying securities whose prices were temporarily below intrinsic value and selling ones whose prices were temporarily too high. It was that easy. Perhaps the most successful disciple of the Graham and Dodd approach was a canny Midwesterner named Warren Buffett, often called the Sage of Omaha. Buffett compiled a legendary investment record, allegedly following the approach of the firm foundation theory. The castle in the air theory. The castle in the air theory of investing concentrates on psychic values. John Maynard Keynes, a famous economist and successful investor, enunciated the theory most lucidly in 1936. It was his opinion that professional investors prefer to devote their energies not to estimating intrinsic values, but rather to analyzing how the crowd of investors is likely to behave in the future and how during periods of optimism they tend to build their hopes into castles in the air. The successful investor tries to beat the gun by estimating what investment situations are most susceptible to public castle building and then buying before the crowd. According to Keynes, the firm foundation theory involves too much work and is of doubtful value. Keynes practiced what he preached. While London's financial men toiled many weary hours in crowded offices, he played the market from his bed for half an hour each morning. This leisurely method of investing earned him several £1,000,000 for his account and a tenfold increase in the market value of the endowment of his college, King's College, Cambridge. In the Depression years in which Keynes gained his fame, most people concentrated on his ideas for stimulating the economy. It was hard for anyone to build castles in the air or to dream that others would. Nevertheless, in his book The General Theory of Employment, Interest and Money, Keynes devoted an entire chapter to the stock market and to the importance of investor expectations. With regard to stocks, Keynes noted that no one knows for sure what will influence future earnings prospects and dividend payments. As a result, he said, most people are largely concerned not with making superior long-term forecasts for an investment over its whole life, but with foreseeing changes in the conventional basis of valuation a short time ahead of the general public. Keynes, in other words, applied psychological principles rather than financial evaluation to the study of the stock market. He wrote, "It is not sensible to pay 25 for an investment of which you believe the pro